Before we get started, we just wanted to thank Old Republic Surety for sponsoring this episode of Let's Get Surety, as well as NASBP's virtual seminars for the third year in a row. For more information on Old Republic Surety, visit www.orsurety.com. Now, on to our show.
You're listening to Let's Get Surety. Let me hear your bonding talk with Kat Shamapande.
Hey everyone, it's Kat Shamapande. Thanks so much for joining us for this episode of Let's Get Surety. Today I have with me my co-host, Mark McCallum, CEO of NASBP. Hey Mark.
Hey Kat, great to be here.
It's always good to have you. And today we're going to be talking about PPP loans. I know we've never talked about this before. It's a new topic. But we are excited to have with us Jack Callahan coming back again on our podcast to talk with us about this. He's a construction industry leader and partner at Cone Resnick, and he's also a member of NASBP's CPA Advisory Committee. Hey, Jack.
Kat and Mark, thank you so much for having me. I'm happy to give you my information, share information, give you as much feedback as I can on what we're seeing out there on PPP 1 and now PPP loans 2.
Yeah.
Thanks,
Jack. So let's start off with PPP loans 1. Where are we now?
You know, that's a real good question. I always caveat it back. We will really know in 6 years from now when they close out the audit period.
Yeah.
What came out in latest clarification was very important for all of our contractor clients. They clarified the tax position on these loans. So we're sitting now, in the last legislation they've passed, they kind of overrode the Internal Revenue Service and said, no, the forgiveness of the debt will not be income, and the expenses paid with that debt will be deductible on the tax returns. So it's really a win for our contractors. Depending on who you are, it could be a grand slam, it could be a ground rule double. We're going to figure it out, but it's a win no matter what it is. And again, it's clarified our position on it from a tax standpoint. So very good, very favorable, and very strong, and something that certainly will help the industry because we're very confident that we are going to face some unsettled and some uncertain times. So when you're looking at it, assessing your client's balance sheets, you won't have to be worrying about this deferred tax or an aggressive tax position here. It will not be taxable.
That's good news.
So Jack, are you still seeing a need with contractors out there for these types of loans as they're going forward into 2021?
We are, Mark, and it changes every day. It's funny, I'm preparing for a local industry group presentation on Thursday, and a year ago they had me, and I talked about the great tailwinds and the strong backlog, and I did caveat, caution for the black swan, and certainly we had a black swan here, and I don't think any of us is smart enough to know what the impact of that's going to be. We've seen jobs get suspended. We've seen jobs get postponed. We've seen housing starts and commercial development starts at all-time lows. You see it in the architectural and engineering firms. So we're going to see, I think as an industry, you're going to see your clients are going to come in, your contractors are going to come in with strong 2020 balance sheets and income statements. They've gotten, basically we got a chance to work through this year. The industry trade groups did a fabulous job of being in front of the legislation and identifying construction as an essential service. So we're going to see some good, solid numbers for 2020. But what you have to really, as a surety underwriter, is going to be looking at the backlog and looking at where the balance sheets, sit for the future, what the projections and pro formas are going to be. Because we think, we said it at the time, we think the economic necessity, we think the need is going to be probably in 2021, and who knows what 2022 will bring.
Yeah. So that kind of brings us to the second round of the PPP. Are there a lot of differences between the first round or a second draw on the loan?
Kat, if you don't mind, let me just jump back quickly on PPP 1, because I think it's important. I've gotten a call from a number of folks in the surety industry, both the sureties and the agents, on what is the accounting treatment of these PPP loans. And, it's like everything else. We thought it was pretty clear. The Financial Accounting Standards Board, which I like to say is the accounting police that I report to, came out with a pretty emphatic position. These Paycheck Protection Program loans are loans. They're loan documents. And when you've got a loan, no different than a line of credit, you cannot take it off your balance sheet until that loan has been formally forgiven, in this case by the bank, the local servicing bank, and the Small Business Administration. At that point in time, you have a forgiven loan. So we thought that was our position. We were going back to our clients and saying it's pretty clear. The large, we always kind of take the lead. Most, as I always say, life is an open book test. And so we got the lead from the public companies. And Ernst & Young and others that are doing the large public company financial statements took a different tact on it. What a surprise. They came about and said, you know what, these aren't loans, even though they're loans. They're going to treat them as grants because there is the intention that they will be forgiven. And there is specific guidance on the grant accounting that allows for the more likely than not provisions to be put into place. So I sat here and I could tell you that it's pretty clear the guidance. These loans should be on your contractor's balance sheets at the end of the year. And quite honestly, I tell my clients that I'm not worried about the surety. The surety is smart enough. They make adjustments. They already take your balance sheets and they adjust those balance sheets for things that they don't like or for provisions that they make. And the sureties are smart enough to say, okay, you've got this debt on the books, but this amount of the debt we can exclude from our calculations and our pro formas. I'm a little bit more concerned about those clients that have pre-qualifications with state agencies. I'm not going to believe that a state agency is going to calculate make an adjustment for that debt that's sitting on the books. That would be sitting on the books as a current liability. So it's more to come. We have, like I said, we've got clear guidance right now. Our firm's position is we're going to treat them as debt and we're going to footnote it, and hopefully footnote disclosures will reveal the fact that it's been forgiven. Although we still have not seen forgiveness yet. We've got a lot of clients. We have seen some clients have gotten the forgiveness, both from their bank and from the Small Business Administration, but the lion's share of our clients have filed for forgiveness with their bank and are still waiting for clarification from the Small Business Administration. So more to come, but keep an eye on how your clients present these on their balance sheets and be prepared if they're on there and you've got the disclosure. I think that this surety community is smart enough to do their own assessments and recalculations based on that. The disclosures is going to be there and the footnote information on whether they've gotten subsequent forgiveness or not.
Well, thanks for bringing us back to that, Jack. I think that's important. I know I've heard a lot of concerns about the tax treatment and how it'll be treated on financials. Yep.
Now we'll run into Paycheck Protection Program 2. It's another $284 billion. I mean, these numbers are just hard to get our brains around how big the dollars are and how big the deficit's going to be as a result of these programs. But the first one was 300 billion. The next one was another 200 and some billion. So 500 billion in the first go round. They've allocated a new $284 billion for these programs. The big difference here is two. They've reduced the number of employees eligible. So under the first wave, if you had 500 or fewer employees, you were able to apply for these loans. Now they've reduced that to 300. So 300 or fewer employees, you can apply for these loans. And then the other thing is they built in we still have the economic necessity. It's still in there in the certifications that you're making, but they've put a hard calculation. I say a hard calculation. I'll explain a little bit more why that's kind of humorous. Is that if you have more than a 25% reduction in revenues in any quarter of 2020 over 2019, you can then apply for these loans. So you have to be under 300 employees and you have to be able to show over 25% reduction of your revenues. And the problem again is we get very little guidance on what revenues are. And guess what? How are they going to address the changes now? Questions and answers. So this morning we got the next round of questions and answers. So we're fighting through it. But what it's now kind of said is, because with a contractor, it's what are revenues? Is it cash? Is it billings? Is it, percentage of completion? And so the IRS has kind of seemed to say, you know what, default to your tax positions. Look at how you're treating these things on your tax return. And if you're on a percentage of completion, do the percentage of completion. If you're on cash, look at the cash. So you've got to take a quarter in the year. Again, a lot of our clients don't do quarterly financials, so it could be a little more complicated than we would expect to come up with. But in our clients' guts, they know if they got hurt by more than 25%. We'll justify the calculations later. But those that are close are going to have to really be careful on how they calculate the projections and how they're able to show and support the fact that they had more than a 25% decline in their revenues year on year.
Jack, do they for the second program? Do they look at your eligibility under the first program before you can then go and seek a loan under the second program? Or are they completely separate animals?
No, it's interesting, and they're combined in a couple of different ways.
Okay.
First off, is that if you got a loan in the first go round, you have to have used those funds in order to be able to apply for the second wave. So again, if you think about it, you were advanced. Our clients were advanced 2.5 months worth of payroll, and they had 6 months worth of 6 months of payroll to justify the forgiveness. So we're not seeing many of our clients having a problem meeting that test. They've spent the money.
Mm-hmm.
What's interesting is there's enough language in here which sort of tells you that they've opened the door again for phase one loans. So we had a lot of clients that went out and filed for the loans under the first program.
Right.
And then they got nervous when the economic necessity questions came up. And some of them repaid the loans. Some of them decided not to take the loans. And so what's now built in this in language, it seems that, again, it's going to come through Q&A, but it seems like they've put in a provision there where if a client gave the money back, they will now have a chance to go back and revisit. We have one client who was very nervous. They're economically sound. They got the money, but they were nervous, so they paid back the loan. But now it's January of 2021. We're past an election. We're past an inauguration. And they're sitting there saying, wait a minute, I now have economic uncertainty. I'm concerned because my backlog has dried up. I was in hotels, building hotels or restaurants or, lodgings. And now I'm very concerned about the future. So it looks like those companies are going to have a chance to go back and reapply for the money they paid back and reactivate. If they haven't, filed for the forgiveness yet, go back and reactivate phase one loans. So it's like I said, it's sort of interesting. We're wrestling with it every day, but it seems like they do tie. So the provision again is you have to spend the first loan dollars before you start to borrow the second loan, and then, as I said, I think there is a window here to revisit determinations that clients made on round one loans as a result of what's built into this provision.
And Jack, it sounds like, we're still getting, new information and finding out more, kind of like we did with the first draw or the first program. So I think it's important just to let everyone know we're recording this on January 19th, 2021, just so you kind of know where we are in the process when you're listening to this recording.
Thanks, Kat. And, the other key provisions on this loan is that differing from the first is that the amount has come down from $10 million to $2.5 million to $2 million rather. So $2 million is the maximum loan that's going to be allowed under PPP 2, but it's still based on the same formula. So pretty much the same dollar amount capped at $2 million as you got in the first loan, you should be able to get on the second loan. And then there's a provision not applicable to us, but just so people know about it, restaurants, hospitality industry got to get 3.5 times payroll because given the crisis that they face. So there are little provisions in there for companies that have an industry code of hospitality or restaurant business. Is
there a separate limit too on single corporate groups and how much they can draw together as a whole?
Boy, that is one of those. It's been in question and answer round one, and it's in question and answer round two. And, as I have to always caveat everything in this vein is talk to your attorneys. There are provisions on what are related parties and how you apply the related party rules. There seems to be enough language in here that you take it by entity. You look at the entity, you look at your cash receipts for those entity, you do the calculations, you look at your head count for that entity, filing under that tax ID number. And therefore, it seems like and certainly clients have taken advantage of the fact, and they've applied for multiple loans under multiple corporate names. But there's enough language in there that makes Jack Callahan sitting here nervous about what the rules of attribution are, and at what point they'll say, you know what, you needed to combine these companies. They weren't, they're alter egos. They weren't all independent and separate companies. So I think that's, something that we all sort of want to pay attention to. But right now, we've got clients, and I think there's enough language in there for people that want to be, on the aggressive side of things, to take multiple loans for multiple companies and not aggregate up and worry about the aggregation on that $2 million now.
Okay.
Now, Jack, I know you've touched on this in the past, on our past podcasts, but it's probably worth reiterating. In terms of documentation, how good a job should these firms do in documenting the grounds for the loan and how they used those proceeds and all the rest? Pretty important, I would imagine.
Mark, it's going to be critical. As I suggested up front, they've built in here an audit time frame of 6 years. Those clients who have filed for forgiveness have probably gotten through their local banks, but by statute, the Small Business Administration had 120 days to determine whether or not they were eligible for forgiveness and grant that forgiveness. We have clients that have submissions out there since August and September.
Oh, wow.
Well past 120 days with no action taken on them.
Wow.
So you could see how the banks and the SBA are struggling with making these determinations. So you want to make sure that you've got all of the documentation supporting all of the positions and all the affirmative statements. You're making statements under penalties of perjury when you file these loans. So make sure that all your information is solid that you're submitting, and then make sure when it comes to all of your costs relevant and related to this, that you've got good, solid background. And again, put those someplace that you're going to be able to draw upon them when people come back somewhere down the road and start to question these loans and your eligibility.
Yeah. Well, you touched a little bit on what payroll costs and those being covered under the second round of the PPP program loans. Have they expanded the criteria for what's allowable or that's non-payroll related?
It has. We spent so much time in PPP 1 talking about what was eligible, what rents were included. You remember the discussions we had?
I do, yeah.
The Porta-Johns in or out, right? Yeah. And the reality is that the loans are based on 8.5 weeks of payroll. And just as in the first one, we now have 24 weeks of payroll in order to use those dollars. So we've found that a lot of those discussions are off the table. Clients don't have to look anywhere past other than their labor costs. And they're able to take those labor costs and more than justify the forgiveness subject to the full-time equivalent calculations, which are still built into PPP 2. So you've got to look at it, but they have expanded now. All the personal protection equipment is now eligible, which it should have been.
Yeah, that's
those
great.
Costs the clients have incurred in order to create social distancing and to meet some of the other needs will now be eligible. So, if you had to redo your staging of your jobs because of this, you can calculate those. Supplier costs where you've had an increase or issues you've had to pay, for advanced shipping because of supply chain issues and challenges, you can take those costs in here as well. And then they've kind of made it a little clearer on the group insurance payments would all be eligible. So been a little more inclusive in this round. But again, formula is 8.5 weeks worth of payroll, and you still have a 24-week period to use the cost. So while we think there's good stuff in there and it allows for it, and those companies who really have been that drastically reduced and their workforce has shrunk, then they can take advantage of the same things, the rent, the interest payments on mortgages, the securitized debt, but now they can get all these additional items of the operating expenses, the PPE, and the supplier costs.
So you've got a few more ways you can use it, but it'd be more things you need to document.
Correct.
Yeah. So, with the second round, there's also been some set asides. Can you tell us more about that?
Sure, and again, the time frame has already come and gone. They made a big deal. They were going to set aside and make preferences for smaller contractors, for minority communities, and it turns out they gave them effectively a week. It was really 3 days from a week ago, Monday to Wednesday, that only small contractors and certain disadvantaged community banks were going to be able to apply and get into the queue. And then on Wednesday, it was open to the general public. The reality is that most of the banks weren't ready. They didn't have the portals up and open, so they only got open in many cases. Some still aren't open, but most of them got online probably on Monday of this week. So the smaller businesses had about a week to get in ahead of the curve.
That's great that they allowed that. It sounds like it wasn't a lot of time. Did you have many clients that took advantage of that? Are you aware of many that took advantage of that?
We've heard some good feedback from some of the trade organizations, the African American, Hispanic American trade organizations that really did a good job of advocating to their base, their membership base, to get in, to talk to their bankers and get ahead of it. So we've heard stories of some success. My client base doesn't, include a lot of those, so I can't give you firsthand, but my involvement in these other trade groups and feedback could indicate that they're grateful for it, because they did get left out, many of them in the first round, and the fact that they could get in ahead of the game here and they've had time to prepare for it was very effective and helpful.
Well, it seems like at this point, as we move down the road, we're still building the plane as we fly it.
Absolutely. One of the other things that's interesting here is that there was additional provision in the CARES Act 1, which allowed for the employer tax credit. So if an employer kept employees on the books and they had jobs shut down, they had been impacted, they could get a credit of up to $5,000, I think it was, for the payroll of those people they kept on during those uncertain times. Under PPP 1, if you applied for PPP 1, you could not get the employer tax credit, the employer retention credit. They've now said that, retroactive, you can now go back. And even if you got a loan under PPP 1 and under PPP 2, you will still be eligible for that employer retention tax credit. So another good savings, another thing that our clients have to be aware of and hopefully can take advantage of and again, save some dollars there as well.
So it sounds like Congress is learning as we go and providing that relief, putting on your your hat, looking towards the future. If they went beyond the second PPP program, are there other sorts of relief you would like to see enacted on behalf of your clients?
They've come out. There was the Main Street loan program, which was out. Not a lot of folks took advantage of it, but a few contractors jumped in. Engineering News Record has identified some of those by name. I'd prefer not to, but they're good for them. They got under that program and they took advantage of it and got some dollars. There's these small business EIDL loans that there was originally under the PPP 1. If you took one of those loans, you had to net it against your forgiveness. So they've now said, no, you won't have to net that against forgiveness. So those are pretty good things. And then, Mark, when I look into the future, what I'm a little concerned with is that while these PPP loans have now been cleared by the IRS, we're running through the process of getting the forgiveness. If you have a contractor client that happens to build federal contract work or they do lump sum time and material cost jobs, not lump sum, but I'm sorry, time and material type contracts, you've got to be careful. The Department of Defense, again, it's leave it to the government. Every time they say we're here to help you, you got to worry about what the next what's coming around the corner. But the Department of Defense put out a directive, an initiative, and they said that if you have gotten Paycheck Protection Program loans and those costs have been forgiven, those costs no longer meet the all events test, and they are not eligible for inclusion in cost plus contracts with the Department of Defense.
Oh, Lordy.
And those costs are not eligible to be included in the workup of your FAR, your federal acquisition rate for the next year.
Wow. So if you by accident include that, then in a sense you could be inadvertently making yourself vulnerable to a False Claims Act allegation.
Correct. And the fact that the Department of Defense has put it out there, again, we're advising to, in some cases we advise to municipal state agencies. And, we're saying, you guys may have a position here to take a hard look at these costs. We haven't seen anybody else getting aggressive on it, but as all these state, county, municipality, and agency budgets shrink and they all realize they have no money, it's only a matter of time before somebody comes back and says, wait a minute, if it was good enough for the Department of Defense, if they've laid out the criteria, do we have a chance to go after that? So given the 24 weeks, maybe you can go through and structure your costs and exclude those costs. And in fact, in the guidance from the Department of Defense, they say that, if you can take the costs on lump sum jobs, make all the lump sum job costs, those that you're asking for forgiveness on, and take the costs that are to cost plus jobs and costs that go into your overhead for the following year, and exclude those from your formula, you can make effective use of the program. So again, to your point on documentation, to your point on getting good advice from your professionals, your attorneys, your accountants, and your bond agents, make sure that your clients are talking through this. They're walking through all the ramifications and they understand how it may. Because yes, false claims or false statement, there's attorneys out there waiting to bring those actions, and there's agencies waiting to bring those actions.
Right. Well, thanks for making those points, Jack.
Yeah. And, I know there's so much information that continues to come, kind of roll out as we go on this. So I think it's important, like Jack said, to keep up on it. You can check out and get more information on PPP in the second round on NASBP's coronavirus resource page. That's www.nasbp.org/COVID. And then I know CohnReznick has a page, a coronavirus center as well. Is that right, Jack?
We do, yes. It's on if you go just to the CohnReznick.com, the homepage, it'll take you to our coronavirus resource center.
Awesome. We'll make sure we include links to that in the description of the podcast today. Thanks so much for joining us, Jack, and kind of helping to explain what's going on with the PPP.
Thank you very much. Let's keep an eye on the new president's agenda. There's a lot of good things out there proposed for contractors by way of large federal fundings for infrastructure. So we're hopeful that the PPP will just be the start of what could be, again, if I take the uncertainty that's there's certainly the opportunity that these large programs could get implemented and really benefit the construction community.
Yeah.
So thank you both very much for this opportunity and the time, and glad to help anytime and give you any of my insights.
You've been listening to Let's Get Surety, brought to you by the National Association of Surety Bond Producers. For more information about the NASBP and its members, visit nasbp.org.
Before we go, we just wanted to say thank you again to Old Republic Surety for their generous support in sponsoring this episode of Let's Get Surety. For more information on Old Republic Surety, visit www.orsurety.com.